All right, I want to move on to some questions about how institutions make investment decisions, and this is of personal interest to me because of some investment committee work that I do. So I'm really looking forward to this. How do institutions decide which investment managers to hire?
Well, they have quote unquote a process, and the process involves an investment committee, and the process involves consultants often. Doesn't it always? There's always a consultant in this. So committees and consultants are delegated. I've sat in investment committees. You've sat in investment committees. A lot, actually, anytime you sit on any committee, the outcome of the committee is very much a function of the quality of that committee. And, if I were to sit on a committee for deciding medical issues, I'd be a disaster. Like, you don't want me on that committee. So what kind of people do we want on an investment committee? Well, we want people with expertise in financial markets. We want people with practical knowledge as well, because at the end of the day, these things have to work. Um, and you have to worry about conflicts of interest. That's also important. Many investment committees do not look like that at all. And the agency problems in those sorts of investment committees are pretty strong. They're often quite severe. So what you see is decision making uh, that from your podcast perspective is not rational, and that's sort of sad. We bear the cost of it.
And how do managers tend to perform after they've been hired?
Well, they do exactly what you'd expect. They perform average. So what does the process look like? Well, you hire someone who's done really well in the past, and then there's some mean reversion in performance, and they deliver average performance. That's not necessarily bad, but it depends on what your expectation was. If your
Oh,
expectation was, this is going to be Rentec, good luck with that.
yep.
You're not going to get Rentec. What you're going to get is the average outcome. So that's kind of what they look like.
which is which is exactly what you should expect. But I think people look at past 3 year, 5 year performance and say, yep, that manager looks good. But as you say, there's no reason to expect them to do better in the future. They should deliver average performance, which is exactly what they do.
Yeah, that's actually another pet peeve of mine, that a lot of professional investment setups have this very artificial focal point of a 3 or a 5 year performance. I don't know what the difference is between 3 years versus 2 years and 11 months. I don't know how it makes a lick of difference. We don't see that in private equity, by the way. But certainly in public equities and fixed income and things like that, you can see in the flow data, if you look carefully, the moment firms or managers cross that 3 or 5 year benchmark, you see an uptick. And that's because people have generated a focal point in their mind that says, I got to wait for 5 years. Why? Because I don't know why, but that's why. And everybody else is doing it, so it must be right. Um, Unnecessary.
Yeah. Uh, so fund managers often get selected based on recent past performance and then deliver average performance. How do institutions decide when to fire managers?
This is a little more nuanced. So you see institutions firing managers for poor performance. You kind of expect that, and you want some degree of that to happen, right? So discipline in financial markets for investors is quite important. So we don't I don't want that, and the equilibrium can't be that number goes to zero. So some poor performance termination is important, but there are other reasons. people make shifts in asset allocation, and they might make them for market timing reasons, or they might make them for very legitimate sort of strategic asset allocation reasons, right? You have to add an asset class, so you got to shrink something else. That's pretty reasonable as well. There's also risk issues. I mean, you can see this if you looked at the press in the last few weeks or months. You saw WAMCO, right? The issues that arose at WAMCO, and what do you see? A flood of outflows. So that's not unexpected that there's risk associated either with personnel or compliance issues, all these kinds of things. So that answer is a bit more nuanced. I think there's more going on.
You mentioned poor performance. How much tolerance do institutions have for poor performance?
Yeah, there's this narrative that's been going around for decades now that they are, quick to the trigger, so to speak, yeah. Right? Very, very quick to the trigger. And my co-author Amit Goyal, who he and I have worked together on a number of things for a long time now. We teamed up with a practitioner in Europe, Ramon Toll, and we surveyed. This was in collaboration with institutional investors, so I should give them credit as well. We surveyed some very, very large institutions around the world to ask them about that sort of tolerance. It was bigger than I expected. Like, it wasn't, 3 years and you're out of here kind of thing. It was a lot longer. So there maybe it reflects the sophistication of the very largest institutions, but they were tolerant. So it's clear that they had some understanding that returns are noisy, and that you have to do more than that. So this goes back to your investment committee part, Ben, that you were asking. That the investment committee has to do its due diligence, which means not just looking at performance, but diving deeper into the organization and doing the due diligence and asking, do you know what you're doing? If there is underperformance, what's the cause? And can I tell whether it's random or something systematic in your process that I ought to be worried about? So they tend to be more nuanced. I like that outcome.
That's good.
You briefly mentioned sophistication. What effect does that have, or how does that interact with underperformance tolerance?
It does quite a bit. I mean, the tricky part is being able to separate signal from noise, right? That's what sophistication really gives you. People who go into a very quick, just like a little attribution system and say, oh, you underperformed because you had money in this sector or this security or this market, and it underperformed. Attribution is backward looking, and that's not a bad thing. Doesn't tell you anything about the future, but it does help you diagnose where the issues arose. And so I think the sophistication part is being able to separate signal from noise, right? Being able to say, here's why this happened. And if you can tell that, you make better decisions going forward. I think that's the key.
Okay, so let's talk performance. How do manager hiring and firing decisions affect the institutional performance on average?
I mean, if they're poorly done, they're going to be a drag, because what's going to happen is that there are very significant transactions costs associated with turnover of managers in the institutional realm, right? So you see this. So you go from a legacy portfolio to our target portfolio. You've got to transition over the securities, and there are firms out there that will do this for you, some of it in kind, and they'll trade the rest. But anybody who's ever sat on a trading desk will tell you that every once in a while you might get a phone call that says, hey, so-and-so large organization is transitioning from, large value to large growth, which means we got some stocks that need to be sold and stocks that need to be bought. I don't need that. That information should not enter financial markets ahead of them, because it's going to cost them something. So portfolio transitions are costly. And if you ignore the marketing hype that you can do this for zero, nothing is done for zero. It costs them something. Ultimately, that's a drag on the portfolio for that institution. If it's an endowment, or a foundation, you're going to be able to pay your students or your beneficiaries less. If it's a retirement plan, that's going to cost you something. Frictions are a part of life.
Yeah, it's so interesting. So the winning managers don't keep winning, and firing losing managers, I think from your paper, kind of shows that it doesn't really matter. So if they just held the managers that they had to begin with, they would have been, before transition costs, just as well off. Yeah, that's definitely not what happens in real life, though.
Yep, it's not what happens in real life. Real life is full of frictions, all kinds of frictions, and all you want to do is minimize those frictions. Right? Yeah, and you're never going to make them go away. So it's I think it's maybe a hopeful but a hopeless exercise at the same time to make frictions go away. Just minimize, do the best you can.
How do relationships between managers, investment managers, and hiring institutions, how do those relationships affect hiring decisions?
I have a cousin who's is a doctor. He's in the dating market, and what is it? He's 30 something, and guess what he does? He gets on his dating app, and that's how he's looking to find a partner, right? But he will also take recommendations from us and say, hey, maybe you should reach out to this person. So relationships matter. They're part of the equilibrium that we live in, and in which trades happen. And finding a partner is a trade, is it not? That's exactly what it is. So it's part of that equilibrium, and relationships do matter. So they can be very helpful because knowing people allows you some information advantage. So presumably, if my wife or I recommend someone to him, then there's some degree of vetting that's already happened. But they can also go the other way, right? You can imagine situations where so-and-so makes a recommendation and there's a side payment, or that it doesn't really help you. So does it work this way in asset management? Of course it does. The relationships are key, and they should be. It's not like they should be non-existent. If you just look at conferences that take place, that independent organizations like Institutional Investor run, those are essentially networking conferences, right? There's some content, but they're essentially networking conferences. So relationships matter, and they matter for whether an asset manager gets hired or not. And that's fine. I think expectations are a different issue, and investment committees still need to do their due diligence, but yeah, they matter.
So you have this paper that looks at this and establishes that this relationship does exist, that if there are relationships between the two entities, they're more likely to get hired. How do relationship-based hires affect performance? Like, does the trust help them find better managers?
Not really. The trust helps them. I mean, financial markets are all about trust, right? I give you my money to manage, or you give me your money to manage. That's all trust. Everything in financial markets is about trust. I pull out a dollar bill, a loonie or a dollar. This is still trust, right? It's trust in the government. It's trust in institutions.
Sure is.
So that's all it really is. So if you hire based on relationships, you don't do better, you don't do worse. You get what you get. You get about average. And that's not necessarily a bad outcome. It depends on what your expectations were. If your expectation was, you connected, I'm connected to you, and we make really good investment decisions, and I expect to earn really high performance, that's great.
Yep.
All depends on what your expectation is. and what the counterfactual is. Because the alternative could be, oh, I
Mm.
handed my money to Bernie Madoff.
Mm.
Um,
Yeah, that's an interesting point.
yeah.
I think either in the abstract or the conclusion of that paper, there's an interesting comment about how those relationships seem to be a little bit one-sided, because when these two people know each other, two entities know each other, the investment manager gains surely from fees, and the customer, the institution, kind of just gets nothing.
Yeah, not all relationships are, it's not like a marriage, which,
Right.
one would hope that marriages are two-sided matching equilibria. That's not always the case.
Hmm.
Sometimes these things can be one-sided. The data in that paper were fascinating to begin with. I mean, they came from this organization called, I think they've been rebranded, but they used to be called Relationship Science. So very good organization, a lot of intellectual capital behind it. And it's amazing what they track. I mean,
Hmm.
if you want to know, Ben, how do I connect to um, Bill Gates? They'll find a way for you to connect to Bill Gates. It might be through two or three intermediaries, but they'll find a way to do it.
Wow.
If it's there, it's there. It's clever. I like it.
Amazing. Let's move on to private markets a bit in this realm. How do institutions choose which private market firms to invest in?
Private markets are a tough asset class. Like I really, really do feel for institutions, and actually investors retail investors as well who want to get into private asset classes. I used to sit on an investment committee that had to get into private asset classes because their clients really, really wanted it. High net worth, accredited clients that really wanted to get into private markets. It's tough. I think the key aspect of what makes it really tough is what we call access. So,
Yep.
I would like access into Andreessen Horowitz or Sequoia, but guess what? They're not going to give me the time of day. I'm a little piddly guy. Um, and that means that if I'm excluded from those because I think that there is persistence in performance, and if there's any persistence in performance in private markets, it's in venture. So I'd like that, but I can't get in there. So what am I going to do? I'm going to go to other places. So this is a bit of a lemons problem. So I'm excluding the right tail, which means I'm gonna be working with a truncated distribution of managers, and that's tough. So if you want exposure, that's not so easy to do. So it's all about selection from that truncated distribution. Unless, of course, if you're the Yale Endowment, you can pretty much go wherever you want. Then you have no access problem. Um, so it's really about managing that. It's tough, not easy.
Well, one of the things that I took away from that paper is that institutions are pretty willing to invest with sort of first-time general partners or people with maybe not a lot of experience managing money. What's the relationship there between first-time or young GPs and future performance of their funds?
Yeah, so this has to do with how competitive markets are. So if you think about, okay, so your investment committee needs to allocate, let's say, 10% to private markets. Okay. You don't get access to Andreessen Horowitz, so you're going to find whatever you can get access to, and maybe you have a consultant that Cambridge or whoever comes along and says, we can get you access to some what we think are good ones. It's still not going to be Andreessen Horowitz. So, and we also think you should take a look at these new folks on the market. So this is a new organization. They used to be at XYZ firm, and now they've created their own organization. You have demand for investment services. You want exposure to private markets. This is your best shot at getting that exposure. So what we see in the data are exactly that. You see large institutions allocate large amounts of capital in aggregate, individually small, but in aggregate large, to what we call first-time GPs or young GPs that don't have a performance history, because you can't see their performance, right? The fund lasts for 10 years. You don't really get to see multiples or IRs or anything like that until 10 years later. So, 3 years into the process, you have no idea what things look like. So it's a little bit shooting in the dark. And in my view, it's basically demand and supply. Allocations to private markets are up. You need to get it invested. Where are you going to go? Subject to the access problem, you're going to go to some new folks. And out of the woodwork are going to come some new folks. GPs are going to get created to meet that demand.
Yeah, that's wild. So there's so much demand for private assets that a GP can kind of just spin up a story and launch a fund without a track record and still attract capital.
They can't, for some GPs, they'll be, this is why, again, it comes back to the devil is in the details, right? Selection is incredibly important. And some of those, I open up a shop, call myself a GP. Am I going to attract capital? Maybe, maybe not. But if I've spent 10 years or 20 years at a private fund, I have a better shot at attracting capital. And, some fraction of those will do well and some fraction won't.
So what are the main lessons that institutional investors should take from your research?
You mean overall in terms of selection and stuff? Yeah. Honestly, if you ask me what the single most important thing is that an investment committee at an institution does, is its selection and monitoring. That is really the key to what they do, because it's not like they manage the individual portfolios. Everything is farmed out to professional organizations that do that. It's selection and monitoring. And selection and monitoring is very much a function of the quality of the investment committee and the people that you have. If they know what they're doing, if they're well-versed in the science and in the practice, I emphasize, I think both are incredibly important, the science and the practice, then they have a better shot. If you take something like the Yale Endowment and compare it to, there's a story in today's Bloomberg about the Harvard Endowment and its relative underperformance over the last 2 decades or so, and how poor it looks and how expensive it's been for Harvard University. If you contrast the two, the Harvard management company is rife with, or was rife with, agency problems. And if you look at Yale setup or Stanford setup, it's not the case. So people matter, and getting the right people in the right places really matters.
Now, your research shows this, and you mentioned you've been on investment committees. You've probably seen it firsthand. Investment committees feel this need to hire and terminate managers. I don't know if it's to look like they're doing the right thing to their stakeholders, or I don't know what it is. Maybe you have an idea on that too. But how would you communicate to an investment committee, or maybe how have you communicated to committees that you've been on that doing that turnover of managers may not be the right thing to do?
Yeah, this is a behavioral lesson, isn't it? Not doing something is doing something. It really is. That's essentially what it is. So you pay attention. I've gone in front of investment committees who have asked me similar questions, and I keep telling them the same thing. Not doing something is doing something. You do your job. Your job is hire, monitor, 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 and then really, if necessary, fire and then hire again. But you don't have to do this. It's not like a haircut. You don't need a haircut. You might need a haircut every month, but you don't need to do this process every month. It's understanding that the signal to noise ratio in financial markets is very low. It's That's really what it boils down to. It takes a long time for us to learn from prices. But that means you have to find other ways to learn. So you have to understand your investment managers, understand what they're doing, how they're doing it, whether you believe their investment thesis or not, what it relies on, where the pain points are. Do they reside in turnover? Do they reside in personnel? Like you have, the WAMCO example from last month. If a person leaves, is that, well, Bill Gross, if you think about that,
Yeah.
right? Person leaves, everything collapses. You don't want that kind of risk. So the investment committee's job, think about risk. That's their one job.
Yeah, makes sense.
And what lessons from this research do you think apply to retail investors?
It's kind of interesting when I think about institutional investors. So I think about the head of an IC, right? The head of an investment committee is a retail investor. They're an individual. So they have the same biases that and preferences that individual investors have as well. So I think every lesson applies to individuals as well. The institutional and retail arena are not that different. The exception might be taxes. From a retail investor's perspective, you got to pay a lot more attention to taxes. Or as I tell my students, hey, you get to buy that car with after cost and after tax dollars. So pay attention. Is it a QDI or not? Are you going to get a tax bill when you didn't even trade? Pay attention to those kinds of things. All of that matters. But other than that, it's the same set of agency problems, the same set of behavioral ideas that exist at the institutional level as exist at the retail level. I think it's exactly the same thing.
I want to ask one more on institutions, just based on what you were talking about there. You mentioned costs and taxes in the case of retail investors. We also talked about the Harvard story where they've paid some pretty substantial fees. How important are costs for an institution managing a portfolio?
Oh, they're incredibly important. I mean, it's a friction, right? All of these sorts of things are frictions. So if you think about an asset manager that delivers a portfolio, an asset manager that delivers a portfolio basically gives you a set of portfolio weights, and those portfolio weights change over time, right? You as the latent owner, that's what you have. Okay, so what are the frictions and costs associated with delivering you that set of portfolio weights? Can I do it myself? The answer is no, because I need research, I need data, I need to be able to trade this stuff, et cetera, et cetera. So all of those costs are essentially get summed up in 2 or 3 different places. One, they get summed up in an expense ratio, and that's explicit. You get to see that. The second place they get summed up is in the after cost returns, because the costs associated with trading as an investor, you don't get to see those because you just get returns that are net of those costs. So those are invisible. And then the last part is the tax part, right? So all of those get summed up. It's incredibly important to pay attention to those. Things that look really good on a pre-tax, pre-cost basis. Momentum is the classic example. There are many organizations that run momentum portfolios. I don't know a single one. I would not touch it with a barge pole, having worked in this area, built portfolios, just trading and knowing what I know about trading over the last 28 years or so. To me, that's a recipe for writing checks to Jane Street, which they need checks written too, but I don't need to write them more checks than they get.
I got to dig into that a little bit more. I know you've got a paper on momentum, and we didn't have it in our list of stuff to discuss. But since you mentioned it, it's a question that I get all the time about, Ben, you talk about factor investing, but what about momentum? Should I be investing in momentum? So you said you wouldn't touch it. Okay, can you just expand a little bit on why?
So momentum. Okay, so let's talk about the other strategy. Take value, take profitability, take all of those. Those are anchored strategies. They're anchored to a fundamental, right? Momentum is inherently an unanchored strategy.
Yeah.
The only thing it cares about is the prior price, and the prior price itself is unanchored. So any strategy like that is unanchored to fundamentals, which means it can have very volatile outcomes. And because it's not anchored, it goes up and down. It goes right. You can see the volatility in the outcomes, and the ship goes all over the place as the tide rises and as it falls. And that means it can have crashes. And we know that there are, if you Google momentum crashes, you'll find, I don't know, probably at least a dozen papers by well-known authors that say, we study momentum crashes. Well, they crash because they're unanchored. So momentum as a strategy, because it's unanchored, generates very volatile outcomes. And for an investor, okay, just take piddly old me. I have some objectives. My objectives are I got to pay my kids' college tuition, and I don't want to be in a situation where I can't write your college tuition bill because my momentum portfolio really crashed. I just don't want that. I can't plan for it. So uncertain outcomes, or as Ken French likes to describe, the unexpected, right? The unexpected is evil. I agree with him 100%. I don't want that. And that's what momentum gives you. And on top of that, it's incredibly expensive to trade. No matter how well you adjust your trading bands and portfolio breaks and yada, 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 there are a dozen ways in which you could try to minimize turnover. But if you minimize turnover, you're giving up expected returns. That's kind of the way it works.
The first part of your answer almost sounded like a risk-based explanation for why the momentum premium exists.
If you think of risk in that context,
right?
I mean, anything that's unanchored makes me nervous. You can think about other strategies, right? So think about like low vol or betting against beta, those kinds of strategies. Those are they're kind of unanchored, but they're based on prescriptive models, right? So they say, CAPM betas, low beta stocks earn higher returns than they should. Well, it's true in the data, but you tell me when's the last time you believed in the CAPM to begin with? So, am I going to use that as an investment strategy? From my perspective, the answer is no, because it's telling me to reject a prescriptive model, but I already agreed to reject the prescriptive model.
Right. Yeah, interesting. That's like basically like the 5-factor model explains low volatility kind of argument, right? Yeah.
Yeah. Yeah,
interesting. Man, I wasn't expecting to go into momentum or low vol, but here we are. I don't think anyone's going to complain about it. On institutions, I had one other question in my head on the why don't more institutions just index?
You gotta be seen to be doing something. That's the hard part. Yeah. That's the agency friction. You cannot make it. It's really hard to make it away. Do we see some institutions do that? The answer is yes. So when you say index, you mean in my sense, like less active, right? Not a passive portfolio, just less active, hold market cap rates and leave it alone, right?
Yeah.
And update. There are institutions that do that, but there's not a ton of them. And the reason is because you got to be seen to be doing something.
Wow, incredible.
Yeah, it really is incredible. And that seems like the right answer, but it's there's been this like indexing revolution for retail investors, but meanwhile you look around at institutional portfolios and not a whole lot of them are, at least not pure index. Maybe they're using more indexing or more less active strategies, but I don't know. A lot of pretty serious active stuff going on out there.
You look at the Nakubo data, for example,
Yeah, exactly.
right? I mean, you look at those portfolio allocations and go,
Yeah.
I don't know what the heck you people are doing, but you're all over the place. It's what it is. Agency
Yeah.
things cost you something.
Yeah. Yeah. Super interesting. And also like, I don't know. It's a shame. Like you mentioned earlier, what's the objective of these institutions? If it's an endowment or retirement plan or whatever, they're affecting real people, and a lot of those dollars are going toward investment managers and alternative investment funds and all that kind of stuff.
Yeah. Yeah.